Imagine finding a futuristic sports car just completely abandoned on the side of the road.
Okay, I'm listening.
Right. So the design is revolutionary. The keys are literally sitting right there in the ignition, but the gas tank is bone dry. And there's a timer on the dashboard just ticking down to 0.
That is quite the visual.
Yeah. Do you get in and hope you can, coast to a gas station?
Mhm.
Or do you walk away knowing it's probably going to explode? Because honestly, that is the exact scenario facing investors today. We are looking at a stock chart that has just gone through an absolute wood chipper, but is suddenly and inexplicably showing these violent signs of life.
Right. I mean, it's the defining tension of deep tech investing, really.
Yeah.
You're staring at this massive disconnect between an underlying technology that could, completely reshape an industry
Yeah.
and a balance sheet that suggests the company might not even survive the calendar year.
Exactly. And we are putting that exact tension under the microscope today for our deep dive. The company is Nuburu Inc., ticker symbol BURU. Just to set the stage for you, it is April 15th, 2026. BURU just closed the daily session at 0.2195, so just under 22 cents.
Which is an eye-catching jump.
Oh, for sure. It's up 7.86% just for the day. So our mission today is to figure out if we're looking at a brilliant, undervalued turnaround play that the broader market has just fundamentally mispriced.
Or a dangerous value trap waiting to crush the retail buyer.
Exactly. But before we get into the order flow and the actual mechanics of, a 1 kilowatt blue laser, a quick piece of housekeeping, if you are watching this deep dive on YouTube, make sure to like the video, subscribe to our channel, and listen closely. It is compulsory that you leave us a comment with your feedback.
We want to know what you think.
We really do. Let us know what you think of this setup, the stock, the whole thing.
And before we dive into the weeds, we need to be crystal clear about our boundaries here. This deep dive is a strictly impartial analysis of the financial data, the technical indicators, and the recent news sources.
Yep, just the facts.
Right. We are synthesizing the material to help you understand the landscape. Absolutely no financial advice is being given here. We're looking at the math and the mechanics, not telling you where to allocate your capital.
Right. With that established, we really have to start with the fundamental reality of the business because, look, an 8% daily pop is a great headline. But the trailing 12-month income statement tells a genuinely terrifying story.
Terrifying is probably the right word for it.
Okay, let's unpack this. The revenue for Nuburu is reported as essentially 0.
Yeah.
It has decreased by 92.7% year over year. I mean, you don't just misplace 92% of your revenue. What is the actual mechanism behind a publicly traded company's commercial engine just stalling out completely like that?
Well, it's almost entirely driven by a strategic, albeit incredibly risky operational pivot. In the hardware and technology manufacturing space, you often see this when a company deliberately sunsets its legacy products.
They just kill off the old stuff.
Exactly. They stop selling the older generation equipment to focus all their capital and manufacturing capacity entirely on a next generation technology. In this case, they're high-power blue laser systems.
Right.
The problem is they stopped the old revenue streams before the new revenue streams were commercially ready to be recorded.
So they're basically stuck in the gap.
Yes. It's what venture capitalists call the valley of death in hardware startups.
Oh, wow. The valley of death.
Yeah, it's that terrifying chasm between proving your revolutionary technology works in a lab or maybe a limited run and actually generating enough consistent, recognized revenue to survive the massive costs of scaling up your manufacturing lines.
And look, the market does not forgive you while you're wandering through that valley. I mean, the punishment is written directly into their net loss.
Whoa, absolutely.
We are looking at a net loss of $71.75 million available to common stockholders over the trailing 12 months. That translates to a diluted earnings per share of negative $2.25.
Which is staggering when you look at the current price.
Right. So to contextualize that for you, this is a stock currently trading at around 22 cents, but losing $2.25 per share over the last year.
Which brings the entire conversation to the single most critical metric on their balance sheet right now, the burn rate.
Okay, let's hear it.
Their cash position sits at approximately $24.6 million as of the most recent quarter. But their free cash flow, the actual liquid capital moving out the door after capital expenditures, is negative $35.17 million over the trailing 12 months.
Okay, but hold on. I'm going to push back a little here. You're hammering them for a high burn rate and zero revenue, but isn't that exactly what deep tech R&D is supposed to look like?
Well, yes and no.
I mean, you can't build a revolutionary industrial-scale laser system on a shoestring budget. Aren't we holding a pre-revenue, highly specialized tech company to the financial standards of, like, a mature retail business?
It's a fair point, and honestly, that is the core of the bull argument right there. Deep tech R&D is inherently capital intensive. You're paying for specialized engineers, proprietary components,
Fabrication facilities, yeah.
right, complex fabrication facilities. However, the public markets are ruthlessly pragmatic. They do not grade on a curve for innovation if the math doesn't secure survival.
The math always wins.
It does. If you are burning $35 million a year and you only have $24 million in the bank, you mathematically have less than 8 months of runway. The market doesn't care how good the laser is if the lights get turned off before it ships.
Which perfectly explains the absolute bloodbath we see when we zoom out on the chart.
Yeah, the 52-week chart is brutal.
Looking at the 52-week range, BURU reached a high of $4.24 back in October 2025. And just last month, in March 2026, it cratered to a low of 15 cents.
Just a devastating collapse.
Right. It's the market pricing in the realization that the company will inevitably have to raise capital to survive.
And raising capital in that compromised position is usually highly destructive to current shareholders.
Because they have no leverage.
Exactly. They can't secure favorable traditional loans without revenue, so they're forced into secondary stock offerings at the market dilution or, issuing toxic convertible debt.
And all of that radically increases the share flow and just crushes the start price even further.
Precisely.
Okay, so if the bank account is mathematically guaranteed to hit zero in 8 months and the long-term chart looks like a ski slope, why on earth is the stock chart suddenly blinking green?
That is the million-dollar question.
Right. Why are we seeing short-term strong buy momentum? If they're out of cash, who is doing the buying to drive the price up nearly 8% today? We have to look at the order flow and the technical indicators here.
Well, this is where we see short-term momentum algorithms completely detached from the fundamental reality of the balance sheet.
Walk me through what the MSTI is actually tracking here, because it just triggered a buy signal at 0.006.
Sure. So think of the moving averages like two runners on a track.
Okay.
One is sprinting, that's your short-term price average, and one is jogging, representing your long-term price average.
Got it.
The MACD crossover just told us the sprinter suddenly accelerated and overtook the jogger. The short-term price momentum has aggressively shifted positive compared to its recent historical trend.
So the algorithmic trading systems see that acceleration and just start piling in.
Exactly.
And you can see that heat reflected in the 14-day RSI, the Relative Strength Index, which is sitting at 65.83 right now.
Getting very close to the limit.
Yeah, so at 65.83, the buying momentum is heating up fast. But we're driving right up to the edge of overbought territory, like redlining the engine before it overheats.
It is, and we can map exactly where this battle is happening by looking at the simple moving averages. What's fascinating here is that BURU is currently trading above its 5-day moving average of 0.216, and it just broke above its 50-day average of 0.196.
So a localized breakout.
Yes, a localized breakout. But the context is crucial. It remains miles below its 200-day moving average, which is sitting way up at $1.01.
The 200-day moving average acts like the long-term memory of the market, right?
Exactly.
Yeah.
And the fact that the current price is a fraction of that 200-day average illustrates the reality of the setup. This is a highly volatile, short-term pop trapped deep inside a massive structural bearish trend.
Okay, let's look at the actual intraday battle lines then. The volume peaked during the midday session today at roughly 3.9 million shares changing hands, centered right around that 22-cent mark.
That's a lot of action for a stock this size.
It really is. We are seeing accumulation rates above 60% at these levels. Buyers are throwing up a wall to defend the 21-cent support zone.
Yes, 21 cents is the immediate line in the sand, with a much stronger multi-month historical floor down at 14 cents.
Right.
Now, if the buying pressure sustains, the immediate upside resistance they have to chew through is at 25 cents, followed by a major descending trendline resistance capping the chart at 30 cents.
Okay, so knowing those exact support and resistance zones brings us to the core behavioral question.
Who is actually doing the buying and selling?
Exactly. Who is playing this game between 21 and 30 cents? Because if we look at market sentiment and ownership data, the professional money is entirely absent. The overwhelming consensus among Wall Street analysts is a hard sell or avoid.
And their absence is clearly reflected in the institutional ownership, which sits in the bottom 20%.
Just a ghost town.
Pretty much. The major mutual funds, pension funds, institutional asset managers, they are sitting this one out entirely. Many of them operate under strict internal mandates that legally prevent them from holding penny stocks trading under $1.
Or companies with negative free cash flow and zero revenue.
Exactly. Furthermore, BURU was outperformed by 99% of the broader market last year. Institutional capital simply does not reward that level of underperformance.
Here's where it gets really interesting. If the institutions are sidelined by their own mandates and the analysts are running for the exits, that means retail traders are the ones driving this massive 3.9 million share volume.
Yes.
It's everyday traders looking at a stock that used to be $4, seeing it flash a MACD buy signal at 20 cents, and assuming they found the absolute bottom.
And that psychological assumption is the architecture of a classic value trap. Retail traders see a steep falling trend channel and assume a low absolute price equates to a deep discount. They buy the dip, thinking the downside risk is limited.
But the downside risk is always 100% of your investment.
Precisely. A low share price does not equal a good value if the fundamental business is actively collapsing under a massive cash burn.
Right.
Retail buys in, hoping for a return to those previous highs.
Yeah.
But when the company inevitably initiates an at-the-market offering to raise the cash, they desperately need to survive.
The retail equity gets diluted into oblivion.
Yep. The price drops further, and the dip buyers find themselves trapped in a structurally losing position.
Okay, that is the grim reality of the bear case, and it's a very compelling one. But wait, we can't ignore the underlying tech because that is the entire basis of the bull case here.
True. They do have real technology.
Right. They aren't just burning cash on, lavish executive retreats. They are trying to commercialize a revolutionary 1 kilowatt blue laser system. And recent news sources highlight an influx of purchase orders from multinational electronics manufacturers.
Which is a huge signal.
It is. So why is a blue laser so important that major international players are signing purchase orders for a pre-revenue company? What's the secret sauce?
It actually comes down to the physics of modern manufacturing, specifically in high-growth sectors like electric vehicle batteries and advanced electronics.
All right.
See, traditional industrial lasers use infrared light. The problem is when you try to weld highly conductive materials like copper, which is the fundamental building block of EV batteries.
Right, batteries need a ton of copper.
Exactly. The copper acts like a mirror to infrared light. It reflects a massive amount of the energy away, resulting in inefficient, messy welds with a lot of spatter.
So they are basically throwing massive amounts of energy at the copper, and most of it is just bouncing right off.
Yes. But blue light is physically different. Copper absorbs blue light almost instantly. So a high-power blue laser melts the copper efficiently, cleanly, and with incredible precision.
Oh, wow. So it's the difference between trying to cut a tough tomato with a spoon versus using a surgical scalpel. One makes a huge mess and wastes effort. The other is just perfectly precise.
That is a highly accurate way to visualize it, yeah. And that precision is why multinational electronics manufacturers are placing orders. In the scale of global EV battery production, faster, cleaner copper welding translates to billions of dollars in manufacturing efficiency.
So it's not just a marginal improvement, it's a massive cost saver.
Exactly. If Nuburu holds the patents and the proprietary technology for industrial-scale blue lasers, they possess a highly strategic, incredibly valuable asset.
So the bull case is essentially that this zero-revenue valley of death is temporary. It's the darkness before the dawn.
That's what the buyers are betting on.
They've transitioned the business, they've secured these critical purchase orders, and once they actually begin fulfilling those orders and recording the revenue, the fundamental math flips. And the idea is that the market will be caught entirely off guard. And the stock will reprice aggressively upward to reflect a functioning, revenue-generating, deep tech manufacturer.
That is the hope driving the buyers today. And in the short term, that narrative, combined with algorithmic momentum, can absolutely overpower the fundamental balance sheet concerns.
Yeah.
If this current high accumulation rate holds above that 21-cent support, we could definitely see a rally toward that 30-cent resistance.
Now, a jump from 21 cents to 30 cents is an enormous percentage return for a short-term swing trader. But you have to be cautious about the mechanics of the dead cat bounce,
Oh,
right?
absolutely.
When a stock has fallen as sharply as BURU has over the last year, a sudden burst of upward momentum isn't always a fundamental turnaround. Often, it's just the mechanical result of institutional short covering.
That is a critical dynamic to understand. When a stock plummets, the entities heavily betting against it eventually have to buy shares to close out their profitable positions.
To lock in the win.
Right. And when multiple large players cover their positions simultaneously, it creates an artificial spike in buying volume. The price shoots up.
And then retail momentum traders see the green candles, assume the turnaround is real, and they pile their own capital in, driving the price even higher.
Exactly. But the institutions aren't buying because they believe in the blue laser. They are just locking in their profits and walking away.
Wow. And once that covering volume evaporates, there's just no foundational demand left to support the price.
None. The fundamental reality of the $35 million burn rate sets back in, gravity takes over, and the stock resumes its downward plunge.
Trapping all the new retail buyers who bought the top of the bounce.
Yep. Which is why relying solely on short-term technical crossovers is so dangerous here. If we connect this to the bigger picture, the survival of Nuburu has almost nothing to do with today's RSI or MACD levels.
No.
Long-term survival is entirely 100% dependent on physical operational execution.
So what does this all mean for the big picture? It's basically a race against the clock on their dashboard.
A desperate race.
Yeah.
The fundamental questions are purely operational now. Can they physically manufacture these 1-kilowatt blue laser systems at scale?
Right.
Can they convert those multinational purchase orders from theoretical backlog into actual recorded bottom-line revenue? And crucially, can they achieve all of that before their $24 million cash runway disappears?
Because if they encounter supply chain bottlenecks or manufacturing defects, or if the technology simply fails to perform at commercial scale, that 8-month runway just vanishes.
It's gone.
The company hits a brick wall, the toxic financing kicks in, and the bear case of a continued crushing downward trend becomes the inevitable reality.
However, if they do execute perfectly, and they begin showing sequential revenue growth from these laser systems, well, the stock is currently priced by the market as if bankruptcy is a certainty.
Yeah, the expectations are at rock bottom.
Right. So if they prove the market wrong, the upside revaluation could be explosive.
Which brings us to the ultimate synthesis of this deep dive. You are analyzing a company sitting on truly revolutionary proprietary technology that solves a billion-dollar manufacturing problem for the EV sector.
Yeah.
They have actual purchase orders in hand, and they are enjoying a sudden, violent burst of short-term chart momentum. But, and it's a huge but, all of that potential is entirely overshadowed by a terrifying $35 million cash burn rate, a temporarily empty revenue pipeline, and a broader market that brutally punishes hardware startups struggling through the scaling phase.
It is the absolute definition of a high-risk, high-reward standoff.
It really is.
And, it leaves us with a critical thought to consider regarding the broader market environment.
Let's hear it.
This raises an important question. In a market that increasingly demands immediate profitability, pristine balance sheets, and instant quarterly gratification, can a company with truly revolutionary hardware survive long enough to actually build the future? Or will the financial clock run out before the lasers ever power up?
Man, that is the exact question you have to answer for yourself if you are looking at the BURU chart today. Thank you so much for joining us on this deep dive into Nuburu Inc. As a final reminder, if you found value in this breakdown, please hit the like button, subscribe to our YouTube channel, and drop a comment below. It is compulsory. Let us know, do you see this as a brilliant, undervalued tech play or a classic retail value trap? We really want to hear your analysis. Until next time, stay curious and wishing you smart, safe exploring in the markets.